Assalamualaikum warahmatullahi wabarakatuh. So let's begin this session with Surah Al-Fatihah. Okay, this session will actually cover other sources of income. So in other sources of income, you would actually have section 4C and also section 4D. So for this particular topic, we are going to cover dividend income, interest income, rental income, and royalty income. So these are the four common other sources of income that normally would be received by individual taxpayer or corporate taxpayer. So of course, in our case, we'll actually focus more on the individual taxpayer in taxation 1. Okay, let's look at first category of other sources of income, which is dividend income. So dividend income is actually taxed under section 4C. So for each particular income, you would actually go through the number 1 definition of those income, and then the basis of the derivation, meaning that is it derived in Malaysia or is it derived from outside Malaysia? So we are talking about the source of the income. Is it Malaysian source or is it foreign source? Okay, and then we are going to talk about the deductibility of the expenses, what are allowable and what are not allowable, and then basis of assessment. So basis of assessment is actually talking about basis year, in which year that it will be taxable regardless of any kind of income. And then of course we also will look at exemption. So this one, it depends on category of income. Some income would have exemption, some income would not have exemption. Okay, another thing when we're talking about other sources of income, of course, in general, according to the backdrop, section 4, types of income. Okay, so dividend income, interest income will be taxed under section 4C. Rental income and royalty income will be taxed under section 4D. Okay, but in certain circumstances, this income might be treated as business income. Okay, meaning that dividend income or interest income or rental income or royalty income will be treated as income under section 4A when it fulfills the criteria of business income. Okay, a simple example, let's say you're talking about investment holding company. Okay, it is a company, so the main activity of the company is actually to invest into another company. So they have the capital amount, share capital, so they invest in another company. So normally at the end of the year or during the year, they would actually receive income from the company that they held certain number of shares. So now, as an investment holding company, that is their principal activity. Of course, their main sources of business income is actually dividend. So in this case, dividend income will be treated as business income. Therefore, it will be calculated in accordance to section 4A. Okay, another example, interest income. For instance, like banking. Okay, banking industry, normally their main sources of income is actually interest income from the loan that they given out to the customer. Okay, and like rental also, it would be possible to be rental income if you fulfill certain conditions or criteria, whereby you have a lots of numbers of properties or assets which you rented out to certain customers. Therefore, you earn rental income. So that also could be treated as business income. So that is in general when dividend income, interest income, or rental income can be treated as business income. Therefore, it will be taxed under section 4A. Okay, however, for this session, we would actually look at how other sources of income will be taxed in accordance to section 4C and section 4D. Okay, let's go back to the first type of other sources of income, which is dividend income. Okay, what is the definition of dividend income? Okay, dividend income is actually, it is an amount distributed to shareholders by the company. So in normal practices, what happens is that when the company has profit, okay, so during the AGM, annual general meeting, normally the board of directors together with the shareholder will discuss about the performance of the company. So if they found that the company has profit, and normally during that period, they will during that time they would actually declare a certain percentage of dividend to be paid to the shareholders, normally based on the profit or performance of the company. Okay, so that's why it is actually talking about amount distributed to the shareholders. Okay, okay. When it is being distributed to the shareholders, of course, in most of the time, it will be in terms of cash. So as a shareholder, you will receive cash. Okay, you will receive cash, and normally, because nowadays is everything is online, therefore you no longer receive any check or any payment slip whatsoever. You just receive notification via email. Okay, how much money or how much dividend that you actually receive for the number of shares that you held in that certain companies. Okay, so whenever you receive the cash amount, so that amount will be taxed based on the amount of cash, net cash amount that you receive from the company. Okay, and then sometimes you might also receive in terms of in kind. Okay, company give you a certain number of shares or certain number of entitlement or rights given to you. Okay, so if you refer to the textbook, because dividend might not be in cash. So example of 2.3, okay, when capital can be capital, when dividend income can be capital in nature or revenue in nature. Of course, when it is capital in nature, it is not taxable. But when it is revenue income in nature or revenue receipt in nature, therefore it is taxable. So in the case of when you receive dividend income in terms of cash, in general, it is actually taxable. Okay, but of course, it depends from year to year in terms of the regulation. Okay, if you refer to para 3.0, page 159 of the textbook, okay, here they mention about bonus shares. Okay, what is bonus shares? Bonus shares is actually when you have certain number of shares, and then at some time company declare that, okay, if let's say you have 5 shares, therefore you get 1 free share. Okay, so in this case, this is bonus or extra shares. Okay, so that means now originally you have 5 lot, now you become 6 lot because you have 1 extra. So the 1 extra shares that you receive, this is actually not considered as a dividend income. This is actually capital in nature. Therefore, it is not taxable. Okay, another one is capital reduction. Okay, para 4.0, they mention about capital reduction when the company is actually try to reduce the amount of authorized share capital. Okay, because if you still remember, when you learn about share capital, you have share capital authorized, and so there are sometimes where they try to reduce that and they pay money to the shareholders. So in this sense, it is also considered as capital receipt or capital in nature. Therefore, whatever amount received by the shareholders is not taxable. Okay, the same thing with the distribution of asset from liquidation. Okay, so distribution of asset from liquidation, in the case where the company is being liquidated, therefore they release all the assets, they dispose all the assets in order to get actual cash to pay back to the creditors, shareholders, and so on. So there are circumstances where shareholders might receive something. So whatever amount that received by the shareholders is also considered as a capital receipt. Therefore, it is not taxable. Okay, it is not part of the dividend. Okay, the next one is right issue. Okay, right issue is actually entitlement or right given to shareholders. Okay, what happened is that sometimes company tell you or give you letter notification saying that, okay, now you can buy certain number of shares at certain value or which is normally lower than market value. So when you exercise your rights based on your entitlement, normally you can purchase whatever number or lots of shares given to you based on the value which is lower than market value to you. So of course, as a shareholders, it is actually benefit to you because when you buy lower than market value, after you buy, you can wait for a while and after that you dispose, because now your cost of purchase is actually lower than market value. Of course, when you dispose, you will get capital gain there. Okay, so that is actually right issues. Therefore, whatever that you exercise under right issues, the assets that you get or capital gain that you get is considered as capital in nature, therefore it is also not taxable. Okay, share buyback is when, because nowadays companies allowed to buy back their shares from the listed or market or Bursa Malaysia. Okay, let's say they originally they have distribute or to the public 1,000 units. So now they want to buy back 500 units from the public. So they can do that. Okay, so what they do, they buy from certain shareholders, they pay to the shareholders. So that means now the shareholders is no longer holding any shares in that company. Okay, so for that matter, when company buy from the shareholders their shares, of course as a shareholder you receive money, so that is also considered as a capital in nature that you receive from the company, which is not taxable as well. Okay, so normally whatever that you receive in terms of in-kind, which normally will be considered as capital in nature, which is not an income, therefore it is not taxable under section 4D of dividend, 4C of dividend income. Okay, so that is the definition. So in general, to make it easier, what is actually dividend income? Dividend income is actually based on whatever percentage declared by the board of directors in the annual general meeting, whatever amount to be paid to the shareholders in terms of cash amount. Okay, derivation. How do we know the dividend that you receive is actually derived from Malaysia, inside Malaysia, or derived from outside Malaysia? Okay, so we are talking about Malaysian source and also foreign source. Okay, the source of the dividend is actually depends on the resident status of the company. Okay, so I repeat. Derivation of the dividend income is actually depends on the resident status of the company. If the company is a Malaysian resident company, therefore that dividend is deemed to be derived from Malaysia. Okay, so how do we know that that company is a Malaysian resident? Normally, it based on where the management and control of the company. If it is exercised in Malaysia, therefore, normally it will be considered as a Malaysian resident company. So, in a simple way, normally LHDN or income tax will actually look at where is the annual general meeting will be held. So, if the annual general meeting is of the company is actually held in Malaysia, therefore, on that basis, you can be considered as a Malaysian resident company. So during that meeting, you declare dividend. Therefore, that dividend is deemed to be derived from Malaysian company. Okay, so it will be considered as a Malaysian source. Alright. So what happens if it is a foreign company? Okay, foreign company in general, normally if you can recall earlier on when I mentioned about Malaysian source, foreign source, so most of the time foreign source of income is actually exempted. Okay, alright. So in Malaysia, we apply single tier system. Okay, what is single tier system? Okay, go back to the definition just now. Dividend is actually being paid from profit of the company. So in general, when company make profit, of course, from the profit that they earn, they have to pay their tax. Okay, so they actually have pay tax portion on the profit that they earn to the income tax office. So in other words, when shareholders receive that dividend has actually been paid, the tax on that dividend has actually been paid by the company to the income tax office. So in other words, whatever dividend received by the shareholders would be exempted from tax. So in other words, whenever the company declare dividend, so let's say 5%, every shareholder will get 5%. Okay, so whatever that you receive, whatever that been credited or transmitted into your account has already been net the amount of tax. So in other words, whatever that you receive will be exempted starting YA 2014. Okay, so that is actually to simplify the process of dividend income, because earlier on we do have tax imputation system. So I don't want to make you confused. You just need to understand what is single tier system. So for one company, when they pay to the shareholders, whatever received by the shareholders will be exempted. Okay? Because here the shareholders can be individual, can also be company. Remember, just now I give you an example of investment holding company. So that is also considered as a shareholders, which is corporate shareholders. Okay, so in this case, this is actually single tier system is actually to emphasize that whatever in the current practice, whatever dividend received by the shareholders would actually be exempted. So it's much easier nowadays. So most of the time, whatever dividend that derived in Malaysia is normally will be exempted. Okay, so whatever dividend that you receive is actually an income. Okay, of course, in order to earn dividend, you might incur at certain expenses. Okay, so for instance, if you want to buy shares from the company, okay, to invest into shares, sometimes you don't have money. What do? You go and take up loan. So of course, when you take up the loan, you have to pay interest amount. Okay, you have to pay also some management charges, because when you are dealing with the buying the brokerage fees, okay, the management charges charged by the CDS, by the Bursa Malaysia, by the brokerage whatsoever. So this is all expenses that incurred in relation to generate dividend income. Okay, so in general, if you incur expenses that directly related to generate dividend income, therefore most of the time, okay, these expenses will be deductible. Okay, and then in the case where sometimes when you have your income is smaller than the expenses amount, of course whatever the difference will not be carried forward. Whatever the excess here will be permanent loss, meaning that's it. Okay, but under the current circumstances, of course it won't happen, because most of the time your dividend income will be exempted. Okay, basis of assessment, as I mentioned, is talking about how do we know that that dividend income will be taxed under which year of assessment. Okay, so normally for the dividend income, it will be based on the day that the payment is being credited into your account. Alright, because nowadays under the current practice, normally because the money is actually immediately transferred in online, okay, into your account, and normally you will be notified from the email. So that is actually the validation to be used in order to identify when is the payment date. Okay, so from there you can actually see for individual, our basis here is a calendar year. Therefore, during that calendar year, whatever that dividend that you receive within that year will be taxed during that year of assessment. So for instance, if you are talking about YA 2019, whatever income that you receive from 1st January up until 31st December 2019 will be exempted, will be taxed in YA 2019. Of course, it will be exempted in YA 2019. However, for business, basis here is actually based on financial year. Therefore, you would see what is the financial year. So if let's say for YA 2019, the financial year is actually starting from 1st July 2018 until 30th June 2019. So whatever dividend that you receive within that period will be taxed for that year of assessment 2019. So it goes back to your basis year. Okay, so individual will follow calendar year, business would actually follow financial year. Okay, and again, as I mentioned just now, dividend income has been simplified. So in general, what we can conclude here is that whatever dividend income that received from Malaysian company or Malaysian tax resident company is nowadays is being exempted because of the single tier system, and whatever dividend received from foreign resident company also will be exempted. Okay, if you can recall, earlier on I did mention whatever foreign source of income, everything will be exempted. Okay, because sometimes you might receive from you invest into a shares whatever listed company in United Kingdom, so you earn dividend. Okay, the amount of money can be credited into your account in Malaysia, or maybe you have an bank account in UK. So regardless whether it is transmitted to UK account or whether it is transmitted to Malaysian account, okay, whatever dividend that you receive is actually exempted. Okay, so in the computation, you have to indicate that the amount of money is actually exempted.